Welcome to today's live event. I'm Andrew Wilkinson with Interactive Brokers. I'm joined today by Tradictive's Jose Blasco. How are you, Jose?
Hi, everybody. Hi, Andrew. I'm very well. Excited as always to be part of these sessions that we do, and important moment in the year as well, as we are nearing towards the end of the year. So fantastic. Happy to be here.
Your chosen subject today is how institutional orders move markets, and it's brought out a lot of our clients to come and listen to you. So just give us a brief overview, if you will, Jose, please.
For sure. I mean, if we were to ask and answer a very foundational question, which is, what moves price, then we could end up with a million different theories explaining what moves price. Could be fundamental theories, technical theories. It could be, someone may blame it on the unemployment number. Someone may blame it on Trump. But the reality is that if we don't have orders being filled behind the scenes in the exchanges, then price doesn't move. And understanding where are those orders, at which price levels, and which are the quantities of orders available that are about to get filled, it's a very important analysis that traders we need to do to understand high probability events in the marketplace when it comes to price movement, beyond the fact that many other indicators or elements that are part of the ecosystem will have an impact, such as again, an unemployment number report, for example. But yeah, there is more to it. So understanding those institutional orders will be an interesting topic for today.
Very good. If you wouldn't mind, Jose, please put up slide number 2, the disclosures and disclaimers from Interactive Brokers, since we might be talking about riskier products, and the audience should be informed of that. Just another couple of pieces of housekeeping. Today's event is live. It's being recorded. If you have questions, please use the chat panel, and I'll monitor those questions, and we'll try and do a Q&A towards the end with Jose. The handouts are available in the handout section. Just expand that by clicking the little white triangle next to the word handouts. Oh, I need to upload that. I'll do that in due course when I've stopped talking. So I'll put that one in there, and you'll be sent a recording link. So watch out in your email about 2 hours after we've wrapped up here today. So with that, I've got my homework now to go and add the handouts to the GoToWebinar panel for the audience. And Jose, if you'd like to take it away, please.
Let's go for it. Wonderful. Thank you so much, Andrew. Thank you so much, everybody, for joining us today. So again, how institutional orders move markets, that's the topic for today. Again, super important. Of course, this is a topic where we can dive deep and deep and deep, and we can get complex. And I want to do that for sure when the time is right for us to dive deeper. But as we begin the session, I will also simplify it, and I will describe how markets move, if you wish, in the form of direct and indirect forces. So we will kind of like think of it as, there is a little battle happening in the marketplace, direct forces, indirect forces, and what happens at the end, right? So that kind of thing, which will be very visual and easy to understand for the ones of you who are newer to trading, and also for the ones of you who are more experienced or advanced. So maybe that very simplistic thinking process, which is very much in line with the reality of how prices move, will maybe get you thinking, even though you may have experience with other trading techniques or other theories on how the markets work. So I'm excited to share this view today, and of course very excited as well later when we get into the Q&A, so we can discuss all of this more in depth all together. So anyway, so objectives for today: first, we need to understand those institutional orders. How do they influence price movement? We'll learn things like why markets often reverse where retail traders enter, right? The typical, I want to use the term complaint, right? The typical complaint of a new trader, which is, I always get stopped out and then it moves my way, that kind of thing. So we'll talk about these more precisely and more specifically. We'll talk about those footprints zones, those institutional areas of trading activity, and we'll do that using charts. We will use TradingView most of the time during the session, but I will be alternating between TradingView and TWS. I will also show and explain how you can connect your TradingView to your Interactive Broker account. So in case you are a TradingView user, you can definitely trade using your IBKR account from TradingView, and so on. You probably know this, but just in case, I will show you how that works, so that way we can all be in the same page. And then the idea is to end up using the information from this session so you can trade with more confidence. And in this case, the confidence, at least the way I think about trading, comes from the point of view of aligning myself with where the big orders are, right? Those institutions, okay? That's gonna obviously put you at an advantage. If you could buy when large market players buy and sell when large market players sell, that would put you at a bigger advantage versus buying when the large market players sell to you and vice versa, right? So, of course, you're probably thinking, how do you know that? Okay, we're gonna do things one at a time, and for sure we'll discover all of this together. So agenda for today, introductions. First, I'll devote some time to talk about what are those institutional orders. Then we'll talk about order flow. Then we'll talk about identifying those footprints, so we know where the institutions buy and sell. We'll do some live demonstration, and I'll be sharing some free bonus resources and tools as well for you to utilize, and then Q&A. So my name is Jose Blasco. I'm a trader. I'm a quantitative strategist as well. I look at markets scientifically, come up with an idea, come up with what could be a valid way on how to trade, but I would not rely on it until I've acted on it scientifically, meaning that I collected plenty of data, I model it, I backtest it, and I basically prove that was an actual theory. And then, it's all about risk management when utilizing those methods. So this is kind of like my trading style. I'm going to share some of these with you today. So talking about sharing and talking about resources, you have a couple of things here on the screen that could be useful to some of you, depending on where you are at. On the right, you have a QR code to go take a look at our TradingView page. And the reason why I'm mentioning this, actually, let me put this on the screen. Andrew and I were kind of talking about what's happening in the marketplace as we speak. And this is our Tradictive page on TradingView. And not too long ago, that was in October 27, I wrote this article, General's Charge, Soldier Stall, Reading Bearish Divergence, where the article was explaining how there was a very serious potential opportunity for the markets to stop making all-time high and start moving lower significantly. And again, plenty of articles of this sort, very educational, as you can see. And again, as a source of resources, this, I believe, could be useful to some of you. And also, we've published a book, and of course, if you like to read, so you may enjoy it. And also for you to know, with the book, you have a course and access to some trading tools that may also help you, depending on where you are in your education journey. Anyway, getting into the lecture here. So we're going to be using the IBKR platforms. As you know, you have the IBKR on desktop, you have the TWS, you have APIs, you have the mobile, all sorts of tools. In today's session, I will be focusing on these 4 steps, 1, 2, 3, 4, which is basically, I'm going to get my trading view. Let me get my trading view. Okay, this is my trading view. And here, down here, where it says paper trading, which is what you see by default with TradingView, I'm just gonna come to the drop-down menu, go for the brokers list, and when I do that, I'm gonna select interactive brokers, and this will connect my TradingView to my interactive broker account. So I get real-time market data. You can see interactive broker green light, right? So I get real-time market data from interactive broker into my TradingView charts, and also if I click trade, and I take a trade, this particular trade would go into my IBKR account. Okay, so everything is connected, integrated, and again, I wanted to mention this quickly so you can follow, and you can then replicate the things that we will be learning, and you have an easy time to follow me. Anyway, so why are we having this conversation today? Why does order flow matter, right? So why is this important? Well, it's a matter of size, if you think about it, and I guess it's common sense. But it's important to denote that institutions move millions or billions per decision, whereas retail traders, they buy 100 shares, maybe 5 futures contracts. Again, it's a fraction of the true market volume per trade, or even overall, institutions are obviously moving so much more size. Therefore, whatever they do have a much greater impact when it comes to price movement, because basically we are talking about the basic laws of economics 101, supply and demand. If you have so much buying coming in and it keeps coming in and it keeps coming in, even though you may have sellers selling at that price, but more buying comes in and more buying comes in, and you still have sellers at that price, but more buyers coming in and they keep buying at that price because institutions move millions. So there is a moment in time where they have absorbed all the sellers. And when all the sellers at a specific price point have sold and no one else is left to sell at that price point, then the market will tick up. And if they keep buying, it will tick up again and tick up. So in other words, the mechanics of price movement has obviously 100% to do with the basic mechanics of how supply and demand moves a price of anything. And in this case, since institutions are the ones who inject the real size in the marketplace, so then institutions have the potential to move the market. Okay, and that's why it's so relevant to understand where is that order flow, right? What price levels, and is it buy order flow, is it sell order flow? So markets move to find liquidity. Finding liquidity, basically, you could think about it as finding the counterparty, what I just said. If an institution wants to buy a lot, they need to find someone to sell to them so they can buy. If an institution wants to sell a lot, they need to find someone who buys from them so they can sell a lot. And those, we can call them liquidity events, right? So they are targeting those areas of price where liquidity will take place. So institutional activity explains why sometimes we get to see on the charts sudden reversals, sharp breakout failures, long consolidations before the big moves. So all of this is basically institutions acting. For example, long consolidation before the big move. It could be that an institution decided to really load on a specific ticker, maybe a stock, an ETF, a bond, a commodity, gold, you name it. And they are trying to do it little by little, because if they were to buy a lot in a way that is uncontrolled with market orders, they would exhaust whoever's on the other side very quickly, and price will move against them very quickly, right? So if you keep buying so much at whatever price, not only you're driving prices higher, but every time you get filled at a worse and worse and worse price, because price is moving higher the more you buy. These are some of the problems that institutions have. Okay, it's nice to be large because you have the power, but you would, in a perfect world, you would want to be invisible so you don't impact the price as you are trying to get an order filled. So sometimes those institutions will have those long consolidations before the big moves, because they use small orders many times within a price range, and little by little they use patience, and little by little, hopefully, they fill in all the orders they wanted, and finally you have a move. So all these kind of patterns that you may see on the chart may have a lot to do with those institutional activities. So understanding institutional intent provides traders with a major strategic edge, because if you were to identify in your chart that an institution is buying there, well, the last thing you would want to do is to short, or vice versa. If you were to identify in a chart that an institution is selling there, the last thing you want to do is to go long, right? So you would want to ideally replicate what those institutions are doing, and even a perfect world to do it before they do it. That would be amazing, right? Of course, it's all about the methods that we're going to use to do it. But first, let me explain the rationale. So what are institutional orders? Well, large orders placed by banks, by hedge funds, pension funds, market-making firms, etc., etc. Often, those orders are way too large to get filled at a single price. And therefore, institutions need to do all sorts of magic to hopefully get filled on the total amount they want. And often they cannot. And they split orders, and they do all sorts of things. They use algorithmic trading, they use high frequency trading, they use all sorts of possibilities at their disposal. But in the end, no matter what they do from a technology point of view, and creativity point of view, and quantitative finance point of view, and any other point of view, the reality is that for them to buy, let's say they need to buy 1 million of whatever, so they need 1 million of selling activity so they can get 1 million of buying activity filled. And if you don't have that liquidity available, then price will move and they will not get filled on all the orders, right? that's their pain, that's their challenge, that's their problem, and that's going to be our advantage, as you will see. But anyway, let's keep going. So their activity drives trends, reversals, and consolidation. So often we see markets consolidating, which is basically institutions in action when it comes to trying to get a very, very large order field, and they're using tons of patience for that. Sometimes you get to see reversals, which is the fact that, you know, like, for example, we saw a clear case in, for example, let me bring a chart. So if we were to go back in time to earlier this year in April, right? So the market was crashing like the world is ending, and next thing you know, you have this crazy strong V reversal, right? There was so much buying there that it didn't take any consolidation or anything, and price started moving in the complete opposite direction. And also, because price had been dropping for so long, for so much, and so fast, and actually even faster speed of drop at the end of the move, you know, which is, if you think about it, it's a bit, it's real, but it's a bit nonsense, if I may use that term. Why am I saying that? Well, because price up here is expensive, it's becoming cheaper, it's becoming cheaper, it's becoming cheaper, it's becoming cheaper and cheaper and cheaper and cheaper and cheaper. And now that price is already very cheap, now people are even more eager to sell when price is very cheap, where typically institutions would do the opposite, right? Institutions would sell when it's expensive and buy when it's cheap. So this very large move, as price already dropped by a lot, it's typically denoting you know, small ticket orders being filled to sell, and therefore, and it's many of them, but it's all small ticket orders, meaning probably retail, and then institutions are going to buy with big tickets, get filled the whole thing, and turn the price around. So you have these very big reversals in cases that are extreme like that, or you have very continuous trend continuations. A bit redundant what I just said, but is what it is. One of the things about trends is that they tend to continue. So you get to see an institution that may buy at a low price and moves the market to the upside because of so much buying, and then establish a new trend, and then they keep buying by scaling into the position because they may want a larger size. They were not able to get everything they wanted at the very bottom, so they keep buying at higher price points, helping the trend to continue developing. And all those activities are something that we see on the charts all the time. So right now, in these initial slides of today's webinar, I'm kind of like telling you all of this a little bit like a story, if you wish, so you understand the rationale behind it. Later, we'll dive into the charts, and I'll be a bit more visual with showing you specific setups and so on, okay? But talking about understanding what's happening behind the scenes, so we need to talk about order flow a little more in depth, right? So what is order flow? Well, order flow is the continuous process by which buy and sell orders come in and out of a market. So as we speak, markets are open, we have the internet, right? So there are people around the world clicking buy, there are people around the world clicking sell, and those orders travel through the internet. And let's say you are trading an exchange traded product, let's say they trade in the NASDAQ, so the orders end up in the NASDAQ exchange, and now, you know, as long as you have a valid counterparty, the orders get filled, and now you got the shares you wanted. Congratulations, that's it. But that process is happening non-stop, sometimes with small tickets, sometimes with big tickets, and sometimes orders that are placed at different price points. Okay, so that's what order flow is. And the reason why this is very important, again, is because, you know, again, obviously those large ticket orders are going to be the key. But before we dive deeper into this, I also want to get you thinking about something very relevant here, right? And the one thing I want us to think about, I'm going to be a little extreme here, so please bear with me on that. I'm going to refer to an event that took place years and years ago. Actually, it's an event that is absolutely not new. But the reason why I'm going to mention that event is because it's real. Okay, I'm referring to the tsunami in Japan years ago. Okay, close to 15 years ago, something like that. It's not a new event, but it was real. And I'm mentioning this because you could argue that the unemployment number may have not been well calculated, may have got a delay, like recently, maybe readjusted after the unemployment number has been reported. You may argue that the Trump tariffs were realistic or not, because after they were made public, they were rectified. So again, there are many news and things that are real, but you may not be able to count you may not be able to count on them as real the moment you get exposure to them. Whereas the tsunami in Japan right? That was real. It was a very big thing. If I was to ask you the question, do you believe the tsunami in Japan, 10, 15 years ago had the power to move the Japanese market, the Japanese yen, and so on? Of course, all of you would say yes. Okay, and on top of that, the other reason why I'm pointing at the tsunami in Japan, and you'll see where I'm going with this, is because all of you would probably say the market is going to go down because the event was very bad news. It was a terrible, terrible, terrible situation. Whereas other events, you could argue that some people may see 4.4 unemployment number as a good number, where some may see it as a bad number. Some people may see the Trump tariffs as a good idea. Some people may see the Trump tariffs as a very bad idea. Again, you could argue that there may be an opinion, and we have all seen times where the unemployment number is good and the market went up, but we also seen times where the unemployment number was good, but the market went down, or the unemployment number was bad and the market went up, or the unemployment number was bad and the market went down. And again, there is a lot of interpretation there, and you never know what. But the tsunami in Japan was a bad event, and it was real, and everybody will understand that it has the power to move the market, and the power would be to crash it, because it was a terrible, terrible, terrible thing, right? So sorry for making it long, but I wanted to make my point, right? So let's say I ask you the question again: does the tsunami in Japan has the power to move the market? The answer is yes. But now what about this? Listen carefully to this variation. What if I ask you, did the tsunami in Japan had the power to move the market if the tsunami had happened over the weekend? And now you may be thinking, okay? And the reality is that, yeah, for sure, on Monday, yes, but not over the weekend, okay? And why not over the weekend? Well, because over the weekend, the market was closed. And even if people were changing their orders, logging in TWS and changing the orders and canceling orders and replacing orders, changing buy orders for sell orders, doing whatever people were doing, the fact is that because the exchanges were closed, the markets were closed, none of those orders would be executed. They would all stay as a stage that we call unfilled. I like to call them UFOs, unfilled orders. And in that stage, they do nothing. In that stage, they do nothing. Only when the market would reopen then on Monday, depending on how people change their orders, and depending on the size of their orders, if they were big or small, when those unfilled orders now started to get filled, now the markets will start moving. And therefore, that leads me into this concept of direct versus indirect forces I mentioned before, which is, okay, so what moves price? Is it the news? Is it the events? Is it the tsunami? Is it Trump? Or is it the orders? Okay, and again, it's now we can play with language, and we can play with English language and preferences and beliefs and all of that, and we can just talk about it from different angles, and we can all be right. But the reality is that with no orders, there is no movement. So in this conversation, I'm going to use the term direct forces to refer to unfilled orders that are in the market, unfilled orders that were placed in the market by large players, those institutions. And I'm going to use the term indirect forces for everything else, which is just as important, okay? The fact that I'm calling it indirect doesn't mean it's not important or relevant. So an unemployment number is very relevant. An interest rate or an inflation report is tremendously important. A change of tariffs with Trump is absolutely important. A tsunami is also important. A war is important, and all of these would fall into the concept of indirect forces in this approach. And the idea as a trader will be like, okay, well, let's make sure you understand both. Let's make sure you understand what's the market environment, what's the market condition, what's going on out there, so you know if it's time to go long or short. But also, let's understand where are the orders in the marketplace. Are institutions buying at this price? Are institutions selling at that price? Is it higher or lower that they buy or sell? Where are they buying and selling? Let's understand the order flow as well, because those institutional order flow will help us understand what's going to happen next. And in a perfect world, we pair them together, right? And you will have a very, very good motivational indirect force to be a buyer, for example, and you will do the buy at the same price at which you have on-field orders, right? Or you would have a very good motivation to sell. From a market condition point of view, economic reports, fundamentals, you name it, anything indirect. And then you would do that sell at a price level where you have UFOs, where you have sell on-field orders. Okay, that would be, in my mind, at least the way I think of markets and trading, the perfect scenario. So indirect forces are those news reports, fundamentals, technical factors. They are subject to interpretation. So it's tricky. Interpretation by definition is subjective. So it often puts the smaller market players at risk of being on the wrong side of the market. So let's find out what are those indirect forces, but let's not be too opinionated about them. And then let's pair that information with the UFOs. And that's the way I like to think of trading. So here's an example. Here we are looking at a currency. We'll look at other markets in a moment. And also I'll look at real-time charts. This is a screenshot on a slide. And here we can see on a specific date, on January 4, there was a report for the euro as a currency where CPI, Consumer Price Index, was being reported. The number before was 1.9. The consensus expected it to be 1.8. The actual number was 1.6. So it was worse than the prior number, and it was worse than expected, which is, using common sense, a bad news. But look at what happened. The euro moved in the complete opposite direction, right? And I'm not saying this happens all the time, okay? But in that particular screenshot, we can see a complete unexpected move took place in the opposite direction. So why could that be, right? Well, it's because of the direct forces. The characteristics of direct forces are the following, right? So movement of price only occurs when those UFOs change status and they become field orders. So UFOs become FOs. We need a way to identify those on-field orders, which removes the subjectivity. Okay. Once we know the on-field, where the on-field orders are, we could approve or reject a trade idea that is coming from an indirect force, which could be an economic report or other examples. I'm going to show you multiple examples coming in a moment. Okay. So now, how do we identify on-field orders? Well, obviously, that is a technology process, okay? We need technology to find the on-field orders, because by looking at the charts, the only thing that we see when we look at a chart, let me get a blank chart here. Here we go. This is a chart. The only thing you see is candles. And as all of you probably know, each of those candles represent the open, the close, the high, and the low of the candle. And you may even get, maybe you can activate volume and you get some volume information, but that's it. Okay, now you can look at chart patterns, you can do all sorts of drawings and plottings and all sorts of things. But now you are stepping into the territory of subjectivity, because the placement of the lines, if you do it manually, may depend on, are you coming from 5 winners in a row or 5 losses in a row? You may have your lines in a different location subconsciously because of that reason. So again, the proper way, at least the way I think about it, the proper way to understand where on-field orders may be is to use tech, because tech is going to be able to pull data beyond what we see on the chart. We're going to be able to load up ticks, down ticks. We're going to be able to calculate ratios of up tick versus up volume, down tick versus down volume, price range to the upside, price range to the downside versus volume to the upside versus all sort of statistical calculations that, when processed in the context of an AI model, will be able to reveal subtle signs which suggest the potential existence of on-field orders. Now, notice that I'm being careful with the words here. Apart from compliance reasons, I'm being careful with the words because that's the reality of the thing. We will never know for sure where these very, very large on-field orders are, for sure, right? For sure, it's too big as a statement, given the fact that those institutional players, they will, again, as I said before, they will play all sorts of tricks, as simple as using iceberg orders, for example. I mean, there are actually, to be honest, there are many tools in TWS, in your interactive broker platforms, that you could utilize, that institutions use all day long to try to hide themselves when they place an order. Okay, those are those algos that are part of interactive brokers, and that all sorts of market players are utilizing to hide their true intention. So knowing it for sure, is too big of a demand or an expectation. But knowing it probabilistically and knowing where orders are likely going to be is a great help. As I was saying before, I'm going to use the same term one more time, is a great help to either approve or reject a trade idea. So in a moment, you will see what I mean by that. So in this case, let me do it with real-time charts here. So when I activate auto UFOs here, so it's plotting these circles, which look like flying saucers UFOs. So those UFOs represent sell on field orders. Okay, so I will come back to this in a moment. Here on the screenshot, you have this band, which represent on field orders. And this is the same chart I showed you before when we saw that the CPI in Europe was reported as worse than expected, but then the euro went in the opposite direction. And now, if you think about this price zone as a price zone where you have buy on field orders identified by technology, so now you will understand how, as a consequence of the report, the euro dropped just a little tiny more, just to hit those buy orders and then turn around and totally reverse. That was the reason for the reversal, like in April earlier when I showed you the chart. So indirect forces are extremely influential. I want to make sure I am not misunderstood by calling them indirect forces. I am not calling them unimportant. They are extremely important, just as important as UFOs, because they are probably the reason for UFOs to be there in the first place. We may or may not know why an institution places a big stack of orders in a market. We may or may not know. But definitely many of the indirect forces that you may identify yourself, for example, the Trump tariffs back in April, going back to that example, definitely were a reason. They were an indirect force, and they were it was massively important, isn't it? So it's very important to keep this in mind. Okay. Now, the smart way on how to play this will be the following. So let's say you have an indirect force, and I'm going to continue again one more time with this economic report. Let's say you have an indirect force. So the smart way is let the market do its thing and let the market prove what the institutions are doing as a reaction to that indirect force or that news or that report, right? And in this case, so we saw the turning points. That may be too fast to catch, okay? Or maybe, again, there's a trading psychology component in trading, isn't it? We talked about this in prior webinars. So maybe while it's very clear to you that there are on-field orders down here, you may not dare to take the trade because of the high volatility at the moment, etc. So again, I could understand all those thinking processes, which make a lot of sense. So maybe one way to approach it, which I'm calling a smarter way to do it, will be to let the market do its thing, and whenever a new pocket of on-field order is identified, now be ready to buy at that price point. Remember, when the institutions buy, in this example, we're looking at this particular leg up, right? This particular move up, that was identified with a green UFO here. So when the institutions are buying there, again, the probability of the institutions to get all the orders filled is limited. When an institution buys and wants to buy a lot, it will take many orders to buy and fill. Typically, you would see a congestion pattern. But in this case, we don't have a congestion pattern, we have a move, which probably means that on-field orders were left behind without being filled. So one of my favorite trading actions would be to wait for price to come back to the UFO and then buy there, expecting a continuation, because we got buy orders here, okay? Likely buy orders, okay? Again, it's never a certainty, but definitely. So this was the price point, okay? So this was the leg up I was talking about. Later on, price came down. This is where I would have been happy buying, and then a continuation took place. Not only that, more on-field orders were identified later on. So again, if that particular indirect force is gonna create a new market condition, let's say a new uptrend. So again, remember what we said earlier, institutions will often step in and add more buy orders because they don't get filled on the total amount they want at the price they want in a perfect world. They need to keep scaling in if they want to fill in a big order. Here's another example. In this case, we got a report. The report in this case is actually a green number. It's a good report. Okay, it was the CPI 1 month later, February 1st. Okay, CPI in this case it was good, and guess what? The euro went down. Okay, now it doesn't matter. It doesn't mean that every time you got a good report it goes down. It's just a coincidence with those two screenshots. But again, same story. Let the news, let technology to pick up on market data and therefore reveal where on-field orders may be in the marketplace, and then join those moves as you get more confirmation. So you are joining the indirect force and the direct force. Instead of just betting on the news is good, I'm going long, or because the news is good, I'm gonna bet it's gonna crash. And you just short or go long in the middle of nowhere, and you don't even know where to place your stop, and you end up placing a stop at a specific distance just because of an ATR or something, and then you get stopped out, and then it goes your way, and you wonder why. So instead, let's try to be a bit more fine with our precision when it comes to market timing, which of course market timing is a big challenge, isn't it? We will never be that perfect, but the more, if we add a little bit of precision to our market timing, just a little bit of a precision will help a lot the reward to risk ratios, and that's going to change the whole trading performance. So let's try to be a bit more precise, and the way to be a bit more precise is by combining those direct and indirect forces. So here's another example. So we have a moving average. It's a classical moving average. Okay, if for the ones of you that are into technical analysis, well, probably you know well and you appreciate very much the 20 EMA, the 50 EMA, the 100 EMA. Maybe you're a Fibonacci guy and you prefer the 8, the 13, the 21, the 34, and the 55. I get you. No matter what, many of those tools are definitely reasons for large market players to trade. So notice how at this moment in time, for example, price kissed the moving average right here. Maybe I'll zoom in a bit because I feel it may be a bit too close, too small. So price kissed the moving average and then it kept going, right? Price here kissed the moving average again, it kept going. Then price went on the other side, kissed the moving average, and then keep going on the opposite direction. So again, that line, it's either true coincidence, or that line is being observed by some trading systems, and trades are fired out of that price level, which is moving average calculation level, right? And indeed that's the case, but at the same time, there are also many cases where price went through like the moving average is not even there, right? So the opposite is true too, right? Price went through like the moving average is not even there. Okay, so how can you increase your chances, right? Again, trade with institutions, find those institutional on-field orders. So notice when we look at the screenshot here below, we have a UFO lining up with the moving average. This is a direct force paired with an indirect force. So the moving average may get more buying coming in. It may or it may not. The direct force is likely representing buy on field orders. It's not a guarantee, but likely, thanks to the technology, we should have buy orders there. So now, when you trade at that price level, you are basically adding more odds in your favor by pairing direct and indirect force together. And here, you can see the very nice move. Now, if someone didn't attend today's webinar, I never heard the term UFO or on-field orders or order flow or institutional. So then they will be looking at this and they will be like, wow, the moving average worked very well that day. But if you ask them, why do you think it worked that well that day and another day it didn't work so well, like here? They will be like, oh, I don't know. Whereas the reality is that every time you got an indirect force paired with a direct force, you have a higher probability of the move to happen versus that if you only have the indirect force by itself, or if you only have the direct force by itself. Because in the end, trading is all about probabilities. Okay. Very good. So hopefully this is helpful. Fibonacci's. Okay. Just giving you one more example here. The time is moving fast. Giving you one more example here. So we got Fibonacci retracement lines. Okay. For the ones of you that are into Fibs. So in this case, we have multiple lines. We have the red one, the yellow one, the green one, the cyan one, the blue one. Each of these retracements represent 23.2, 38.2, 50%, 61.8%, etc., etc. The classical moving, the classical Fibonacci retracement levels, right? Now, the question is, which one should you trade? Should you trade the red line? Should you trade the green line? And the answer is, well, all of them have potential to work as an indirect force. Each of those Fibonacci lines may have, like for example here, we can see a beautiful turning point originated from that red line. Beautiful, right? So all of those lines got the possibility of working well, but there are also cases where price went through the line, in this case the green line, like the line does not even exist. So again, just like the moving average, it may or it may not work. It's an indirect force. It's a powerful force, but it does not work all the time. So how can we stack more odds in our favor? Well, turn on technology, identify unfilled orders. And in this case, we have a red UFO lining up with the green line, and we have a green UFO lining up with the red line. So what should you do? Well, the right action would be either to wait for price to go into this fib and expecting prices to drop. Why? Because you have the fib line that is likely going to add as resistance and attract sellers and sell orders, but you already have sell orders in place, likely. Again, it's all about probabilities. So then all of this together increases the odds of a turning point. Or let the market do whatever, and then when it comes back to the green, buy, because this Fibonacci line, the red one, is likely going to bring price higher, not only because the Fibonacci red line may attract buyers because it may act as a support, but on top of that, you already have buy orders in place, which will, the two together, will give more power to this, okay? And you can see that that's exactly what happened when price rallied. It went through the yellow line, like it's not even there, and then it kissed the green line and created a beautiful reaction. And then when it comes to the red line below, and again, those are examples, okay? This does not work all the time, but it's example of real trade opportunities, and it's definitely helpful. So here you can see how price went to the red line, and then you have this beautiful move. So again, just like before with the moving average, if a trader didn't attend today's webinar, didn't learn about UFOs, and was looking at that Fibonacci line, we'd be like, wow, beautiful move out of the red Fibonacci line, but I don't understand why it went through the yellow one, like it's not even there, right? Well, it's the UFOs, okay? It's the institutional orders, which is the whole subject for today. And by the way, I keep talking about the use of technology to identify that. There are many tools in the marketplace that you could find on the internet for you to understand better the order flow available in the market. The one that you have seen me use a moment ago, and you will see me use it again, is Auto UFOs. You could certainly take a look more in depth on our website, but the whole concept that we are discussing today is not limited to Auto UFOs. It's order flow. So whatever tools you use, will bring in that advantage, as long as you think of markets in terms of direct and indirect forces, and you try to pair them both, or you maybe even be a bit more perfectionist, and maybe you bring in multiple indirect forces, right? And you want a moving average lining up with a Fibonacci retracement line, lining up with the breakout of a triangle, technical analysis, etc., etc. So, and then you have your UFO. So you can make it as complex or simple as you want, but the idea is to combine those forces to add orders, and most importantly, going back to the title of today's webinar, to avoid trading against the large market players, avoid trading against the institutional orders, because that would more often than not, slap us on the face, isn't it? Anyway, so detecting UFOs, you can see sharp price departures, as I showed you before. You can see long wicks, aggressive rejection, but all this is what you see visually. There is more to it. The human eye cannot reliably detect unfilled orders with detail, because it requires to process much more market data, and really, ideally, you would plug all that market data using a financial model, ideally AI models, machine learning models, instead of classical, old school finance models, such as linear regression and things like that, that would be too simple. And by processing all that data, so you get those, subtle plots on the screen that give you an edge. Okay. So Auto UFOs analyzes all that data and automatically gives you the green UFOs, the red UFOs. Green UFOs represent buy on field orders, red UFOs represent sell on field orders. So now, understanding all of this and coming back to what I just said, which is to avoid to trade against the institutional orders, this is going to avoid you falling into traps and those fake outs, right? That typical breakout trade that then looks like it's breaking out and then stops you out, right? Those kind of trades are typically happening because we are buying when it's time to sell or selling when it's time to buy. For example, we go back to Bitcoin futures, for example. Okay, so we had this very, very strong, significant drop. Okay, and it just went to kiss a green UFO and stopped and started reversing. Right. So let's say at that moment in time, you were looking at your market here, and you were looking at this very, very, very relevant turning point. I'm just going to use the magnet, and you were to select this very relevant turning point, and you were calling this support. And now price went through support, and right below support, you decided, okay, it's going to continue crashing, and I'm going to do a breakout trade to the short side. Okay, so that would be a short breakout, right? Well, what would happen is that for a moment, you would see Bitcoin to move in your direction just by a little bit to end up moving aggressively against you and stop you out. What was the problem in this case? If you did that, and again, I'm not saying you have done that, or and I'm not saying that this didn't happen to me either. Okay, this is definitely something that could happen easily if we don't think in terms of on-field orders. But if you now think in terms of on-field orders, you will know that shorting down here, it's too late, it's too risky. And the reason why I'm using the term late, which is subjective, is because I'm pairing late with the fact that you are about to see buying coming in. Okay, earlier in the move, doing the same thing made a lot of sense. But at this moment in time, with that UFO in place, it didn't make sense to keep shorting because the buying was about to come in. Okay. SPY, for example. Okay. Similar story. Okay. SPY coming down, hits the UFO, turns in the opposite direction. Okay. That particular day, the SPY ETF dropped 1.52%. Okay, 1.52%. So probably that was scaring a lot of people. Again, what do we have here? Very, very relevant turning point. Everybody would see this guy. So below that, people are ready to do the breakout. Especially after such a violent day, people will be like, oh my God, the world is ending. Let's break out. Well, if we didn't have that UFO, it makes sense. But with that UFO in there, well, you are not pairing direct and indirect forces together. Okay, therefore you have less odds. I'm not saying it could not work. I'm not saying all UFOs actually work. Price sometimes will go through. But again, probabilities are probabilities, and the more tools in your favor, the better. And in this case, beyond tools, we're talking about not having the institution against you. So the tool will help you to identify that, but it's really avoiding the institution against you. Okay. NVIDIA, very relevant stock. Okay. So take a look. A few days ago, same move down. Okay, same move down. So for the people that did the breakout trade to the downside on NVIDIA, same story. It goes down, bounces in the opposite direction violently the next day, gapping up. Okay, many people are now being stopped out to then see NVIDIA come back down. Okay, now why is NVIDIA coming back down? Well, again, some people may say, look, it's because there was a resistance there. Okay, or some people may draw a resistance using this high. Again, there are different ways on how to do technical analysis. I will not get into that, but some people maybe were calling that purple line a resistance, and it went to resistance and it came down. And probably is that, and maybe is that, and I don't know for sure, but it's possible. But the reality is that that resistance line was lining up with a sell UFO. So notice how the blue candle after the drop on that day, price came back up, open gapping up here, rallied up into the red UFO, and from there gap down. Why is it gapping down? Because of the sell orders, intense selling. And why do you have an intense selling? Because maybe it's not the UFO, maybe it's the resistance, or maybe it's the UFO, it's not the resistance. But when you put the two together, you increase the probability of more selling. And that got NVIDIA to come down. Okay? If we were to look at Goldman Sachs, very similar setup. But what's the difference? There was no red UFO. Okay? No red UFO. So again, same setup. So you have this very relevant turning point here. Many people with Goldman Sachs maybe were looking at that as a relevant resistance, a relevant support. When price went below, they were doing the short breakout, bad idea, because the institutions were ready to buy, green UFO. Price keys the UFO, rallies on the opposite direction. But notice how NVIDIA went down where Goldman Sachs didn't. Now, could it be, apart from the technical reasons I'm giving you, such as support and resistance, could it be that there is a fundamental reason why NVIDIA is down today and Goldman Sachs is up today? It could be. Maybe there have been some reports, some, new deal or new cancel deal for NVIDIA. I have no idea. I didn't look into it, to be honest. But beyond that, we had sell orders on NVIDIA, but we don't have a red UFO on Goldman Sachs. So because we don't have a red UFO on Goldman Sachs, we know there is less selling. And because there is less institutional selling, price is more likely going to move higher. Anyway, we need to use, we've been using TradingView for analysis and IBKR for execution. Entry methods, when you identify those trading zones where buyers have field orders, could be to use limit orders, wait for price to come back into the UFO and take the trade then with a limit order. Or you could use stop breakouts, breakouts out of the zone. So for example, let's go back to NVIDIA. Okay, we are in the green, so price is likely going to go up. Okay, but let's say you truly believe that your indirect force is very, very bearish. And what you believe is that maybe what's going to happen is that this green UFO may only have the power to do something like that, and then it's going to go back down. Okay, but what you could do is that you could place a stop sell short order here. Okay, so it's a stop sell to short order. And in other words, when you have the evidence that the green UFO is gone, now you short, and you are doing a breakout where you have room. Okay, not like this breakout where there was no room to the next green UFO. Here, there is room. So you could do the breakout below this UFO and ride the move. So you are not trading against the institutional orders. Or you could use a limit order and, trade until it gets to the red. And the red probably is a good place where to set your target and exit, right? Because when it goes to the red, it's likely going to go back down. So this is the idea. Of course, always manage your risk. So stops should be logically placed beyond those institutional zones. The moment you place your stops beyond the institutional zones instead of the typical pivot turning points kind of thing, you will very likely see much less stop outs because your stops are not where the institutions are looking for liquidity. Okay, so that's the key. So institutions don't chase price, they wait for price to return to their zones. Traders, we should mimic that behavior, wait for price to retrace or wait for price to violate those UFOs and then do the breakout trade, but do the breakout of the UFO as long as the next UFO is far away. So you have room to make a profit instead of it's gonna reverse in front of you. Very good, so key takeaways as we are getting into the Q&A. My God, the session went so fast. So markets move because of institutional order flow, not retail activity. On-field institutional orders leave footprints that they can be identified. We can use tools like the UFOs I've been using to identify those tools. And the key is to avoid trading where the institutions are hunting for liquidity. And that sometimes requires patience, which is essential in trading. Anyway, so I'm happy now to get into the Q&A. Also, I said I will share some resources with all of you. So earlier I gave you one QR code, now I give you two. One of them is for you to get your articles, as I mentioned before, but also AutoClimate, which is a tool that I haven't used today, but I use in almost any other session, which is the tool here below. This is a tool that you can get for free, and you can just scan the QR code, and thanks to ABKR, you can just enjoy it on your TradingView. Anyway, Andrew, I'm eager to know more about the questions that we may have.
Wonderful, thanks, Jose. Amit asks, he says, you may have covered this already earlier. How do you enable viewing UFOs on the chart within TWS?
Yeah, in our case, this is a proprietary tool. So you will need to come into our website. This is a subscription tool, and then it will be activated under indicators. There is a section called invite only. So then inside invite only, you will have your auto UFOs. Okay. So you will need to take a look at our website and feel free to ask questions. You know, you can also connect with me via email if you have questions, and that's how you get it on the TradingView charts.
And I think, yeah, you mentioned it was TradingView charts, which IB uses too in the platforms.
Correct.
Do you find there are particular stocks where this theory works better than some other stocks?
Yes. So in the end, we are talking about institutional order flow. So another way to think about that is institutional interest. So if you are looking at stocks that, I'm just going to be pragmatic here, stocks that no one trades, meaning like penny stocks. So then this approach would be a disaster. It would really not work, because you are relying on institutional order flow, and institutional order flow for penny stocks is going to be 200 shares. So it's not going to move anything. Penny stocks are not traded heavily, which is why they're penny stocks. If institutions were to buy penny stocks heavily, then their price will go up and they will not be penny stocks anymore, right? So I'm just going for an extreme, so the point is understood. So in other words, when you are dealing with stocks, you know, very relevant stocks that are part of the Dow Jones Index, stocks that are part of the S&P 500 Index, NASDAQ 100 Index, etc., this will tend to work quite well. There is also a feature in TradingView, which is going to go for a very large market, the S&P futures, for example, which is very large. There is also a feature where you could enable stats. So you can also get to see, you know, and you can also adjust calibration settings and things like that. And it gives you, in this case, you can see the figure here on the upper right, 58.85%. This is telling you probability of those zones to do something significant. If you were to do the same on a stock, which is a very small stock, very small cap, very little volume per day, that number may drop to 30%, 20%. And that would tell you that there is no institutional interest. Therefore, there is no institutional orders that are relevant that could be useful for anything. So then you would just discard this type of approach or theory on those stocks because it would not be useful.
John asks a question, do you give more importance to technical or value analysis in your trading decision-making strategy?
It depends. So I am much more technical, also because I like to be active, and technical trading strategies give you more opportunities to be in and out. Therefore, you know, being technical it's a bit more, it's closer to what I like to do. But at the same time, value investing, fundamental analysis, etc., could have great value if you give yourself time, right? Because maybe you have a stock which is overvalued or undervalued, and maybe it's undervalued. No one has noticed yet, and it's going to take 2 years to gain more value. So maybe you bought way too soon, even though you were right. So you are totally off timing, even though you were right, right? So value investing or fundamental analysis makes a lot of sense, but you gotta massage the time element, because you never know when that value will translate into price action. So I like to do that with options. Okay, with options, you can implement option strategies where you use various expiration dates, and if price is not moving, so at least you collect time decay. And in other words, you are not wasting your time while you wait for the move. Okay, which maybe you acquire a stock that pays dividends, so it's not really wasting your time. But again, with that pragmatic approach, I like to add options to the mix when I think more fundamental and value investing versus that when I think more technical.
Very good. Just about out of time, Jose. A couple of people have asked the question, will there be a link to the recording? And the answer is yes. This recording will be sent to your email in a couple of hours from now and will be available at the Interactive Brokers campus under the education menu. Jose, thank you very much for joining me today.
Thank you so much, Andrew. Always a pleasure. Thank you, everyone, and see you in the next one.
Okay. Thanks, Jose. Bye for now.
Bye-bye.